Okay, let's redo again because just now I forgot to share the screen. I hope won't take up too much of your time now. So good morning, everyone. Thanks for joining. So this week, we'll just go through the usual first, and then I saw there are a couple of questions on from the Slido, so we'll go through that as well. So let's look at the weekly recap first. The first one I'm showing here, this is the S&P 500 index. Currently it's at close to 3,700. So it was down 4.1% over the past 1 week. But if you look at year-to-date index, right, I think S&P 500 is down like around 23% now. So if you look at the QQQ, it was down 3.7% over the past week. But I think year-to-date basis, QQQ down even more now, because now, you know, with the Fed rate or the rate increase, right, all the tech stocks are affected more than S&P 500. And also year-to-date basis, I think energy sectors has been performing quite well. So that one helped to shield the S&P 500 from the losses. But if you look at just past 1 week, right, you see here, QQQ is down less than S&P 500. That's why I pulled out this chart from Finviz showing the relative performance of different sectors. Apparently for this week, right, energy was down quite a lot. It was down like 9%. And other sectors, you know, like consumer, real estate, I think these are the sectors that is, they are more affected when the economy is doing badly. Whereas for, you know, like utilities, defensive, these are considered the stable one. They are down less. But I think the energy is quite interesting because since the Ukraine war, right, we all thought that commodities is just going up and up. But this week, apparently not the case. Then let's talk about energy first, because I know I think some of the members in the group also pay attention to energy a lot. But if you look at the energy prices, right, which is the Brent crude oil prices, it has been going down, I think, for a couple of weeks already. Now it's already about $88. So just, I think Friday it was down 4%. So it's quite a big drop compared to the market rally periods, right? So I think the energy prices is kind of like slowing down. I think there are some people who are betting that these lower energy prices will lead to lower inflation. But so far, the inflation report that came out recently, it doesn't show the case. It seems that the inflation is still quite high. That's why there's all this fear about continuing increase in interest rates. Then the next one, of course, this week, you know, market down a lot. It's all after the Fed announcement, right? So quite interestingly, when I just briefly look at what has been reported, right, the 75 basis point, this is not something that surprised market participants, because if you look at, for example, like last week we talked about the implied probability, right? So I think it's quite clear that they will hike 75 basis point. This is the third time they are doing this. But the surprising one is the trajectory or the communications that's given by the Federal Reserve. Basically, the 75 basis point is like in line with expectation. But if you look at next year projections, right, it seems that Federal Reserve is going to hike rate continuously, and they are going to do they are going to force the interest rate to be higher just to cool down the inflation stuff. So if you look at the Fed fund rates, right, so this is the history of Fed fund rates since 2000. So you can see that prior to global financial crisis, they also increased the rate for a lot, and that crashed the housing market, right? After that, they have to lower the interest rate down all the way to zero. And then 2018, there was one round of monetary tightening, and then COVID hit, they bring it to zero again. And this round, you can see that it is very steep. And right now, I think just this week, they increased it another 75 basis point. And this is very, very steep. Then the part that I think is quite interesting is, you know, this is already happened, right? So now we are already at around about 3%. But if you just compare to last quarters, right? Last quarter, they are projecting it to continue to increase, but the steepness, right, is like not exceeding 4%, right? But Q3, I think what is new is that they're seeing that the inflation, there's no sign of slowing down. So they really have to check out the interest rate a lot to cool the inflations. And then at first they say that, okay, increase the interest rate should be okay. Even if there's a recession, it will be a mild recession. I think now slowly, right, Jerome Powell is slowly pulling up all this narrative, like talking about soft landing. I think the message has changed, and now it's more towards that they don't care so much about the economy. And even they might say that the economy really need to slow down in order to bring the inflation down to a level that within their targets, which is 2% inflation targets. So you can see that now the projection is that by next year, it will be around like 4.5%, right? So actually this one is the one that hit the market. Not so much about the 75 basis point. The 75 basis point, I think this is in line with expectation. Then the next one, if you look at the implied rate, I think this is quite clear, right? If you just rewind back to maybe just like 1 or 2 months back, right, you don't see that market is projecting that the Fed fund rate will go to 4.5%. I think it's more like 4%. But now it seems that it's not enough. They really need to bring it up, right? So we can see like we are going to see another 75 basis point and then another 50 basis point by end of the year. So when the interest rate is at 4.25%, right, I think this is really, really painful for business owners, for whoever that is taking up debt, and maybe for whoever that have like houses and then you have mortgage to serve. If your interest rate is not fixed, right, it's based on floating mechanism, right, then you will really feel the pinch. It's quite painful. Then we already see that the effect already like flow into the bond markets. If you pay attention to the bond yield, right? So, you know, this is just, we are talking about the overnight rate, right? But if you look at the 1-year rate, they are very sensitive and they track along with the Fed fund rates closely. So now the 1-year treasury rate is already at 4.1%. But over the past week, I was observing the 10-year rate. 10-year rate, right? Usually they are supposed to be more stable. They are not as volatile as the Fed fund rate, which can move like, you know, like couple of percent within like a couple of months, right? But usually for 10-year rates, they are rather more stable. But we are seeing that since early August, right? It has been continuing going up. And just this week, you can see that this is quite steep, right? This is the pattern where people usually describe it as like melting down. Like you can see that on the bond markets, it's already like we are seeing a huge movement now. So now 10-year rate is about 3.7%. If this one continue, right, imagine that we go for another 75 basis point, another 50 basis point. When the Fed fund rate is at 4.25%, right, I don't think the 10-year rate will be below 4%. I think it's just a matter of time where they're just slowly going up to above 4%. Any questions so far? Because I hear there's some noise. Anyone want to ask any questions? Okay. If not, then we'll just continue. So I think someone asked, right, in the group that given that, you know, like 10-year rate, 1-year rate keep going up, is this good or bad, right? So I would say that it really depends on the profile of your own profile. For example, what are you investing in, right? So, but at least one thing is clear is that for those who invest in bonds or they invest in bond funds or they just place their money in deposits, right? This one is definitely good news, right? So I think for those who are based in Singapore, I think quite a number of people, they will like to save their money in Singapore saving bonds, right? So this one is quite simple. This is just instrument that allow you to, park your money buying Singapore government bond, but this one is not the typical nominal bonds, right? This is like a step up coupons kind of bonds, right? So if you look at the placement, let's say if you place it before 27th of September, right, you are getting 2.75%. So we are able to get this kind of rate is also because now yield is going up, right? So I think when interest rate was low, this number is about, let's say, like even below 1.5%. So now you can get additional 1% or 1.5% just because the yield has went up, right? So this one is definitely good for bond investors. But for those who, this one, just to whoever watching, right, just want to let you know that if you wait until next month, right, actually the next month issuance will be about like 3.1 to 3.2%. We can know this just by looking at what's the yield level that they are trading at for the 10-year Singapore bond. So we can see that we are seeing all this, from US side, they are hiking interest rate. It spill over to Singapore as well. And now we are seeing that Singapore interest rate is also slowing, going up now. But what does it mean for stock investors, right? So I think what happened is that as the interest rate going up, right? Let's say if you are indifferent between a bond and equities, when the bonds or when the fixed deposit is only giving you, let's say 1.5%, you will have more like tendency to like just put your money in equities, right? Because it doesn't matter whether you put in bonds, you are getting a very low yield, or if you are taking on margin, it's also very cheap financing. But now isn't the case, right? So there will be people who say, okay, if I'm able to get 3.1, 3.2% by investing in an instrument that is essentially risk-free, right? Why should I risk my money in stock market, right? So that's how the bond and equity market like kind of like affecting each other. So that's why I would say that as the yield go up, your prospective return will be higher. And this is like mathematically true for bonds. But because of the relationship, because all these capital market, they are kind of linked to each other, right? So on equity side, you should expect a higher return as well. But how do we get a higher return, right? It is because the price level will come down. Similarly, I mean, when we're looking at bonds, right, how bond can give us higher return is also because the bond price has came down. So similarly for equities, I would say that the price should adjust downward just because now the liquidity is sucked out from the systems, right? You are getting a much lower kind of valuations on stocks. And that is actually an opportunity for whoever who are still buying and accumulating assets, right? So I don't know. I mean, for a long-term investor, if you are still buying, you're still accumulating, I'm sure you hope you can buy at a cheaper valuation level, right? And usually this is the period where, when the monetary is tight, and then there's fear in the market and stock price is weak, and that's the best time to accumulate. And I mean, if you can look beyond, let's say 5 years, 10 years, you will get a good returns from the equities. Okay, so this is just some update. Let's go to a question. Actually, when I look at the Slido, right, there was one question, but just now I look at it, there are a couple more new questions. We will go through that later. But because Martin, I think he sent the questions quite early, so I have some time to pull up some information, and then maybe we can just look through some of the details that I have prepared now. So the question from Martin is that, what's the difference between T-bills and TLT? Question 2. If I'm to buy TLT via interactive brokers, how do I collect the interest? Okay, so let's go through the basic first. So, the T-bill, right? This is essentially just the US government bond period. So when we're talking about T-bill, this is US government bond. But sometimes there are a couple of different, wordings. The T-bills are usually referring to those that is shorter than 1 year. I think for those, let's say like between 1 year to 10 years, they are called treasury notes. And then maybe some longer one, they are called treasury bonds, something like that. There are some variations in terms of like the namings, but all of them essentially, they are the same. They are the bonds issued by US governments. So this is very simple. If you buy a T-bills, right? So you actually own the IOU. And that IOU is issued by US government bonds. So this is like single bonds, right? If you buy one bonds, that's one bonds. I think you can buy, it's written here, right? You can buy as low as 1,000. You can actually buy it from interactive brokers if you want. It's rather quite simple, but just pay attention to the transaction cost. What I heard is that I think you might need like $5 just for like one transaction. Seems that the transaction cost is slightly higher than like just buying some ETF or some equities. So that's something that you want to pay attention to. Then the next one is, let's look into TLT, right? I think this is TLT is essentially just an ETF. So ETF, right? I mean, for those who might not know in details, right? Actually, ETF is just like a fund, but the difference compared to like let's say like an index funds or mutual funds is that ETF, right? They are like a companies that holding invest in something, and the company or the fund itself is like packaged in a way that is similar to like a securities, and then it is traded on exchange. So when we say you are buying TLT, right, you are buying this ETF, the shares of this ETF, and then this ETF, they will own whatever they invest in, and then whatever they invest in really depends on their mandates, depends on their strategy. It's quite simple. For whatever ETF, right, actually you just do a Google search, you just type like TLT ETF, they will bring you to the website, and then there are a lot of good information that you can find from the website. I think I like the websites, especially from those, I think this is from the BlackRock, right? They are written in a very simple way to help you understand what is all this ETF is all about now. Okay, so I mean, just from the name itself, you can see that it is iShares 20+ year treasury bond. So exactly this is a bond. They invest, right? They invest in a treasury bond, meaning US government bonds, that is only 20 year and above. So for government bonds, you know, they have this term to maturity, right? Some bonds, they will mature within 1 year, some will mature in 3, 5, 10, 20 years. I think the longest one for US government bond is up to 30 years, if not mistaken. I believe that. What it means is that they only invest in bonds within 20 to 30 years. So you see, this is written here, right? Exposure to long-term US Treasury bonds, targeted access to specific segment. So they are only investing in US Treasury market. There are some bonds that invest in different markets, and then some are focused on corporate bonds, some are focused on government bonds, some invest in all types of bonds. So there are different variations. But if you just look at their website, you will see that they are written in a very clear manner. Okay, so what is the difference if we invest in the bond itself or versus TLT, right? So TLT, right, this is just like you don't directly own the government bonds. You own the TLT, and then TLT own the bonds. So it's just like an indirect kind of investment or exposure to government bonds, right? So what happens is that this fund itself, right, they will manage based on the index. So they will just buy, let's say, imagine that they have like 30 holdings, right? All of them, some of them is like 20 years maturity, some of them, let's say 25, some of them 28 years, right? So if a bonds drop below 20 years, right, it doesn't fit to the criteria, then they will just sell it, and then they will just rebalance to whatever bonds that is within their criteria. So in a way, this is like, they are passive, but then they are managed funds, and they are managed in a way that is according to their strategy, which is only own 20-year plus government bonds. So you imagine that this is something like you have a manager that is acting on your behalf, right? So they say they only buy based on this criteria, and then they will just keep on reinvesting. So it's quite simple. It's just that you don't directly own it. And then let's look at some of the key facts, right? I think one question that asked by Martin is that how do you receive the coupons or like the dividends, right? So I think just from this exactly the same website, right? If you pay attention to this one, distribution frequency monthly. So what it means is that they pay out the coupons on a monthly basis. So I checked their schedule is really, I don't think like, maybe they might miss 1 month. Let's say if their holdings don't have a coupons received, right? Maybe they don't pay that. But if you look at their payout history, really, as long as I think they receive some coupons, then they will just pay out. So if you own the ETF, then you just receive it as if like, I mean, the mechanism is exactly the same as buying equities and then receiving dividends. So I think for ETF, they just call it distributions. They're not calling it dividends. But these are all essentially the same thing. So bottom line is if you own the ETF, you will receive cash flow on a monthly basis. Then how much yield that you are getting, right? I think this is not a fixed yield. I think it depends on the coupons that they receive. So imagine that this fund they receive or they invest in government bonds, right? So whatever coupons that they receive, they will just pay out. So if you look at the 12 months trailing yield, right? Trailing means they look at the past 12 months, how much is the total distribution, and then just divided by today's price, right? You get about like 2.3% yield. But if you look at 30 days, right, it's about 3.6%. So it's slightly higher, just because I think the price has went down, and then price went down, the yield came up. Like this is looking at the recent past, right, 30 year. So it's a bit higher. But both of these, right, 3.6 or 2.3, these are not the expected return that you are getting by investing in the fund. If you want to know, just based on today's capital markets, right, you want to know if I buy this ETF, how much expected return that I should get, right? You should actually look at the average yield to maturity. So what is yield to maturity, right? It's quite simple. So if you only own one bond, right, the yield to maturity is essentially the IRR of that bond. The IRR means that, if you own a bond, you will have coupons, and then you have some maturity cash flow, and then what's the price that you are paying for, right? So if you work out the IRR, or the internal rate of returns, right, you will know that's exactly the return that you are going to get. But this is for single bonds, right? For this ETF, you have more than one bonds. You see here, you have 33 bonds, right? So average of these 33 bonds, the average of their yield to maturity, right, you are getting 3.8%. So, if given nothing has changed, right, you will get 3.8% over the course of the fund. But this is assuming that the fund is kind of like just own the bonds and then just run off, right? But the actual return will not be 3.8% because the capital market is not fixed. They will change over time. So assuming that you own this ETF and then the yield, the 30 or the 20-year bond yield just shoot up, right? What happens is that the price of this ETF will come down, and then you will have some loss because basically imagine that now you are discounting with a higher interest rate. The price should come down, right? But you bought it, let's say you bought it at $20, now it come down to $18. So you will just immediately have the 10% loss now. So this is definitely possible for ETF because, if you own the bonds, it's exactly the same thing, right? As the yield goes up, the price come down because you bought it at a higher price, right? So you will suffer some we call the unrealized loss now because now the price has dropped. Meaning that if you need to sell, then you have to sell at a loss now. But the future cash flow is the price, as the price change, right, the future cash flow is still the same, right? Because for government bonds, the future cash flow is kind of like fixed cash flow. So I think that's some basic 101 for ETF. I hope that they have answered your questions. But before that, let me just close it with like some 2 more slides on these topics. For 30-year bonds, basically your yield, right, is if you look at the US Treasury yield curve, right, this is the yield that you are getting. So if you own the bonds and then you own it to maturity, you will get exactly around like this 3.7 or 3.8%, right? So this is the yield that you are getting. But because this is a fund, right, so it is traded, right? So as the yield, let's say this 3.8, assuming 3 months later, this level is at 4%, right? So the price of TLT will come down. So that's the risk that you are running. And how sensitive is the price to the interest rate, right? This is the measure that we should look at, which is the duration. The longer the durations, right? Because the cash flow is further away from today's date, right? As the interest rate goes up a little bit, your price will come down a lot just because the duration is long. So, this is just some mathematics because you are doing some discounting as the cash flow is further from today's, right? It becomes much more sensitive to the interest rate. So it's about 18 years duration. What it means here is that if the yield go up by 1%, you should expect that the price will come down by about 18%. So TLT is kind of quite volatile one just because of the duration is quite long. But say if you want to invest in some bond ETF, but you don't want to invest in such a long duration one, right? There are different maturity buckets one. So you can, there's one named GOVT, right? That one is like they just own the US Treasury bond across the entire yield curve. So they own all maturities. So that one, I think the duration could be about like 6 or 7 years. Or you can say, let's buy some short-term one, say shorter than, I don't know, maybe 3 years, right? So there's also some bonds that is shorter. The shorter one is currently the yield to maturity is longer, is higher. So I think you will get higher return. So you might be curious, like why should I take on more risk and getting a lower returns, right? So it really depends on your outlook, right? So for those who buy the TLT now, let's say if you bought it at when the yield is 3.7%, imagine that let's say 1 year or 2 year later, this 30-year rate is trading at 2%, right? For example, yield has just collapsed because let's say the economy is bad, right? So as the yield drop, the TLT price will goes up. So that's unrealized gain. Or if you sell your TLT that time, you can really pocket a gains, right? So I think for those who own TLT, maybe this is their strategy as well, right? So they just want to bet that the yield will go down in the future. So you can just lock in 3.8% now. As the yield come down, they can just profit the gain. So this is also something to take into the considerations now. So I'll stop here on this topic. Just want to see Martin or anyone else you want to ask anything to do with this topic or any things that I presented so far.
Thanks, Boon Tee. Can you hear me?
Yes.
Very well done. Very well done. In fact, I think it's very impressive. Okay. I think you have answered almost all my questions, and it's quite pretty clear. So actually, if I think most of us are actually, the mindset of putting in bonds is so that actually at least we get the interest. So actually, if the price of the bond goes down, of course, I think most of us might not be in favor. I think but of course, actually, you did mention about strategy just now. I think it also makes sense. So I think that if I do not want to raise the price, but still get back the interest periodically, then I think it makes more sense to buy the treasury bills directly, or go to the banks and get those big C directly. I think that makes more sense.
Yeah, I think you are right. So if you don't want to take this price volatility and you still want to invest in something that's safe, right? I think the way is to just buy those very short-term ones. So say, for example, let's say you buy a less than 3-year ETF, right? The duration is very low, so there are some fluctuations, but they are very short, like very low volatility, right? So that's one way to do it. And if you just buy the bond itself, right? Say, for example, you buy a 1-year bond, right? Of course, if you buy a 1-year bond, let's say you buy $97, and then you know that when it matures, you get $100, right? So you get about, let's say, 3%. Or let's say you buy $96 and you get back 100. So you pocket that $4 when it matures, right? So during that 1-year period, right? Say, for example, the 1-year rate shoot up to 20%, right? You look at the price of that 1-year bond, it will still come down one. But you don't really care about that because you know that after 1 year, you'll get back your $100 anyway, right? So the price of the bonds, it doesn't matter because it's like within 1 year, you get back your maturity anyway. So that's how we say if you own bonds and you hold to maturity and hope that this maturity is short maturity, like within 1 year, right? So you kind of like secure your capital is already guaranteed. You know you get back that 100. You know that you are paying $96. So it becomes like there's no price fluctuation, no risk, right? But what happens, the mechanism is exactly the same as you own a 20-year bonds, meaning that the 1-year bonds is also fluctuate. But it doesn't fluctuate as much because, you know, they are very close, right? So you discount at, even if the yield go up to 20%, right? The $96 that you bought, it might come down to $80. But doesn't matter, the price is $80, so you just wait until it matures in 1 year, you get back your $100. What it means is that within that 1 year period, right, your $80 will very quickly trend towards $100 anyway. So as the cash flow become nearer and nearer, right? So this is the mechanism. So you understand the mechanism. I think you know, like, okay, let's go for the short-term one. Go for 1 year treasury, or if you place a deposit, right, with the banks, right, they usually have a maturity of, let's say, around 1 year. So it's the same thing, right? It's very, I think in terms of mechanism, they are the same. So you kind of like guaranteed your capital already.
Okay, Okay, so actually, okay, based on what you mentioned, if I paid the instead of the $100, I paid $96, so that it goes up and down. If I terminate halfway, can I say that I will terminate at a loss?
Yes, you are right. Even if you buy 1 year bond at 96, it could drop to $80, assuming that 1 year rate can go to 20%. But this one haven't happened. Like you can quote that in the 70s, 80s, it goes up as high as, I don't know, like close to 20%, right? So it happened in the past because the inflation just totally haywire, right? But I think just to highlight the situation is that as you go up, your bonds will come down. Yeah.
Okay, I think thank you. Yeah, thanks, Boon Tee.
Okay,
thank you.
Thanks a lot for the questions, and I think sometimes it's when we have questions like this, then we just go through some of the basics and then just go through this, right? I think this is a good opportunity to let those who are not familiar with like some bond ETF. I think it's good to go through as well. Okay, I think let's quickly just go through. I think this one later I'll go through this stuff. Let's just go through some of the questions that asked by members here. So this one we have go through. Before this, right? Any questions or any topic that you guys want to discuss? Okay, if not, we just go through some of the questions here and then closing. That's why this is, I think there are a couple of crypto questions. I don't know whether it was posted by the same person, but anyway, we will just go through it. The first one, why is Bitcoin a store of value? Can something that is so volatile be a store of value? I think it has been some time that we discussed about Bitcoin, right? I don't know why. These topics we talk about, invest for the long term, but it seems that the crypto questions come up quite often. I'm not a crypto expert now, but I will say that let's go through this statement, right? So Bitcoin as a store of value, there are two different ways to look at it, right? So I think there are people who say that because Bitcoin, the price is so volatile, and something that the price is so volatile cannot be served as a store of value. So I do agree with this statement, because imagine that you say, I want to buy some Bitcoin, I just want to park some money there, and then I might need the money anytime, right? It could be like next week, could be 1 year later, then I will need to sell my Bitcoin and then use it for, and to spend it, right? So if you have this kind of mindset, right, you just say, I want to park the value somewhere and I want to park in Bitcoin, I would say that it doesn't make sense to do so, just because of the price volatility. Okay, so I will make the first statement I will say is that it doesn't make sense. Bitcoin is not a store of value if you are thinking of you need to sell anytime soon, right? So, and this is actually true for equity as well. So for example, if you buy in stocks, right, and you say, hey, actually I want to buy a house next year. To me, buying stocks is just a store of value, but I need the money next year or 2 years later, right? So stock market can also crash within 6 months, within 1 month even, right? So they are quite similar in this way. So meaning that anything that has high price volatility shouldn't be seen as a store of value, especially if you need the money within a short period of time. But the second view, right, is that how Bitcoin works, right? If you try to understand the technical sides, right? So, like all these proof of work, you want to see how the mechanism works, the decentralized nature, all these things. If we understand the mechanism of how Bitcoin works, right, the mechanism works exactly the same whether the price is at 1,000 or 10,000 or 100,000. The Bitcoin itself doesn't care about the price because they have their own units, right? So they operate based on their own units. They just work as if nothing has changed regardless of the price. So this is something unique about Bitcoins. So if you understand how it works, right, you really need to see things like it's denominated in a Bitcoin terms. So they don't really care about the price. The price is just depending on the supply and demand at the point of the trading. So at any point of the any point when the market is trading, which is like 24 hours and 7 days a week, right? They are trading, right? Depending on the market manipulations, depending on the supply, demand, the news flow at the time, right? There's always transactions happening, and then this supply demand will just drive the price, and the price can go up and down all the time. I won't be surprised to say it just shoot up to, let's say, like 100,000 within like 3 months, or it just crashed to 10,000 or 5,000 within 1 month, right? All this can happen. So it is really subject to speculations. The price keep going up and down, but the mechanism of how Bitcoin works and how Bitcoin works is essentially just a ledger of recording which wallet own how much of the coins, right? It's just like that. So it's just a ledger recording stuff. So basically that's it. So if you understand how it works, I think you understand that the price is just like, how to say it? The price is just supply and demand. They're just trading in and out. And then if you happen to sell when the price drop, right? So you just have to take the loss now. But when I say it's okay to own some Bitcoin, I come from a perspective that you are okay with the price volatility and you don't need the monies, right? And you kind of like say, okay, I think this is a assets whereby the supply of the coins, right, is kind of like fixed. You don't get devalued over, let's say, 10 years, 20 years times, right? It's not like dollars, right? Dollars, if you look at the amount of dollars, it keep increasing every year. So you get diluted as you just own US dollar or Singapore dollar. All these currency, they are all trending to zero. But for Bitcoins, at least we can know for sure that the total supply, right, there's a cap on it. But a cap on the total supply doesn't guarantee that the price can only go up, because essentially it's still based on supply and demand in the future, right? So if the story of Bitcoin continue to, like gain tractions, and then people kind of like say, okay, I'm fed up about all this inflation. I fed up about all this inflated away because US government just continue to print money and so on. You say, okay, I rather believe on the Bitcoin story, which is controlled by algorithms and then supported by all the Bitcoin communities, and you trust the story and you think that this story will have traction 5, 10, 20 years down the road, right? Then it's okay to own some Bitcoin, given that you plan to hold it over the long, very, very long period of time. But another thing is you need to make sure that you need to know that Bitcoin itself is just like currency. They are not productive. They don't produce things, right? It's just a record. It's just a decentralized ledger record. So I think what I just talked about, like in a couple of past minutes, right? You kind of know these are the big pieces of Bitcoin. If you understand all this, right, you will know that what will drive the prices. But even we know what will drive the prices, we kind of don't know where the price will be trading at, because it's really depend on the supply and demand, and no one can kind of project where the supply and demand is in the future. We can we can project the supply, but we cannot project the demand. And once the story kind of crashing down, nobody believes the story anymore, right? It can go down to zero. So I think you just need to know the facts on Bitcoin now. So then you know whether this is something for you or not. And if it's not something for you, then just stay away, though. Then if you stay away, then I can guarantee that you won't lose money now. Yeah. Okay. I think I'll stop here. I don't know who is asking this now, or anyone else here. If you have any point to add on this, or you have further questions on this, yeah, please let me know. Okay. No question. Next one. Crypto question again. Ethereum is now a proof of stake cryptocurrency. Some say that will make it more decentralized. Is it really a bad thing for a utility token to be decentralized? Yep, I think Ethereum is now proof of stake. I think this is true. But whether it will make it more decentralized, I think this statement is wrong, because I think if you understand, I think the proof of stakes, right? If you understand what's the proponents or what's the advantages of proof of stake is when you try to analyze what's the energy cost associated with the operations of entire blockchain, right? So for Bitcoin, people always challenge that, okay, this one sounds good, but then it just, because of the proof of work mining activities, right? It just kind of wastes energy, right? I think this is true because, yeah, I mean, as long as the Bitcoin is trading at a price that makes sense for the miners, right, they will just continue to do the mining. And then again, minings, right, the value that they created is just to validate the transactions, right? And they don't really create value for the society, right? So that's why people say that it is like a waste of energy. But the good thing about proof of work is that you can assure that this is decentralized, because basically you will tag this to how much computing power and how much energy that you have, right? So that's actually something good for proof of work is decentralized. But for those who, for the proof of stake, the problem of this, the good thing is they are very energy efficient, but then the bad thing about proof of stake is that it will become more centralized, because whoever own more of these tokens, right, they will have more say about how this blockchain is going to be governed in the future. So, this is getting a bit more into technical already, and I don't want to comment too much on that, because I think if you understand that, right, you will know that it might become more centralized, and then whoever own more tokens, they call the shots. And this is always a bad thing for any blockchain or any communities that say decentralized is the most important thing, right? So yeah, I think that's the thing. So I think for those who are okay with proof of stake, I think they are mostly looking at it as a utility token, not so much on like store of value. So and as long as they are able to build applications on top of this Ethereum blockchain, right, I think they are fine. And it's not just the energy, right? I think proof of stake is a lot more, a lot more faster. They have more, I forgot all the technical names already. They can basically produce more transactions per time periods. I think this is something that is the advantages of proof of stake. Okay, I'll stop here. Getting a bit stuck already. Anyone want to help me out on these questions? Give your viewpoint on this. Okay, if not, let's continue. What are your views on the Meta stock? Anyone own Meta here? Or let's say I just like pass it to Boonsong first. Please help out a bit on this. Do you have any view on this, or GY?
Don't have, I have no interest in Meta.
Why?
Because the outcome of Meta depends on the future of a tech that I have no idea which company will have the best chance to win.
You mean the metaverse?
Yes, the metaverse.
But what about their core business? Like just forget about the metaverse, right? It just because their valuation is so cheap that if you just like take away the metaverse, right? Just assuming that you take the price and buy the company and you only own the legacy business, right? I think it could still be quite attractive, right?
Okay, I've not been following, but tell me how much it earns, like trading 12 months for their main core business. Do you have any rough idea how much they earn?
I think their PE is about like low double digit, in the teens, right? Let me check.
Yeah. So the thing is, I also checking at the same time. The thing is, I don't really like to bet on earnings, because I have a very, very simple way of looking at investing. We typically look at the amount of cash they have, and then take it away with that. So let's say if a company like Meta is maybe, how much is Meta stock price?
Yeah, I'm showing the PE now. I think the PE is at
11.64, right?
Yeah, 11.
More towards what kind of earnings the advertising segment actually earns. Because you when you look at the PE, right, the earnings is actually subtracted due to costs from the metaverse, right? So if we just assume that the metaverse, they totally give out on the metaverse or they spin it off, okay? So let's say if Facebook spin off its metaverse arm, the market will appraise the company more favorably, because the metaverse is a drag on earnings, right?
Yep.
The meta segment, yeah. So if you could tell, like Like, okay, so maybe Facebook is now worth 377 billion, right? And the advertising arm is 30 billion, for example, in terms of earnings per year, right? So that will be dirt cheap lah. That will be dirt cheap, but you can't guarantee that times the earning power for the advertising segment will go down. So as well as the returns in safe bonds and all that. So because when people invest, right, they look at the returns coming from safe assets, such as bonds are. And they think, should I spend more, pay more for equities? So as bonds go up, equities will go down. They will demand a higher price. So these two, I usually don't want to bet on earnings. I don't want to bet on earnings on like Meta, unless it's ridiculously cheap.
But don't you think that this is already like ridiculous cheap? Because you see right now the PE is about like 11, right? Assuming that their let's say their earnings just drop another 1/3, right? So the PE will go up to, I don't know, like let's say 16, 17, right? It's still not excessive, right? Given that this is still the companies that is leading in terms of digital advertising. And then although on their Facebook core products, which is the Facebook, right? It's not doing that well, but in terms of Instagram, I think they are still doing okay. And then there's still a lot of things that they can do on the WhatsApp and the metaverse spending. I think this is very hard to bet or to guess how are they going to compete with others. But if they see that they are, they can always scale down in terms of their investment in those areas and pump up their earnings, right? So don't you think that this is quite attractive given that the PE is already quite low? Yeah.
So if we were to look at Meta as a investment vehicle opportunity, then the way I see it is I totally disregard the losses coming from the royalty labs, because after all, when you become a public company, right, you have this obligation to please shareholders. So they will try to do something that will please shareholders. Maybe they will spin off the royalty labs segment. Okay, I'm just taking a look at the 6 months earnings from the family of apps thing, right? That's about, in 2021, for the last 6 months, they earned 28 billion. In 2022, they earned 22.6 billion. So that's a good amount of reduction. But let's say that the royalty labs of loss of about 5.7 billion is not going to take into account in the future. Let's assume that it's going to be spin off lah. So 22 billion. And then you look at the market cap for Facebook. I don't know whether I want to do that, you see. To me, that is still possible amount. There's still a possible amount of downside. No, I'm not very sophisticated, so I only go in when it's ridiculously cheap. So Facebook is not one of them. I also look at the balance sheet. Give me a while. Yeah, so 12.6 billion of cash and no debt, right? Yeah, no debt.
Yeah, quite clean one. Their balance sheet, no debt.
Yeah, but not ridiculously cheap. So you can take into account that the cash probably evens out. But they still have 27 billion of marketable as securities. That's about, give or take, 14 billion in terms of cash. So if you take 14 billion in terms of cash, take away all their liabilities. Yeah, I'll say that it's a good bet. Let's assume that maybe Facebook start to decline some more and they will start to spin off their royalty labs thing. Then the Facebook price of Meta platforms will definitely increase. But no possibility. I don't see that happening. Because Facebook has no record of doing that, right? Spinning off their subsidiaries.
No, I don't think they will do that. They might scale down the investment in metaverse. They won't spin it off now. I think because they changed the company name just to say how serious are they in the metaverse, right? I think they see this as, because they already hurt by Apple iOS just because they have to stay on other people's platform, right? It's like I go to your house and then I set up a shop at your house and then earn a lot of money there. And then you, as your house owner, you might say that, why should I continue to allow you to operate in my house, right? To build a business here. So they will have all this, don't know what, the privacy stuff and so on, right? I think that one really hurt Facebook a lot. And it's not just iOS, right? They might face the same thing on Android as well. So they always stay on other people's platform. And now because I think, all these things, they keep on changing, right? We used to be on the desktop. Now we are mostly on mobile. And then the next next platform will be on Metaverse already, right? So they just want to own a piece of that, even though it is not easy to compete, right? But still, they know that this is the investment that they cannot skip, so that they have to make their positions more resilient. Right now, I don't think, I think they are at a very bad positions. So one comment is on the spinning off. I don't think they will spin off, but they might cut the investment, which I think they already did. But in terms of how much is the magnitude, I still need to check. I'm not too sure.
Yeah, and if you look at FinBiz and you look at all the insider trades, it's all sales. So I don't think it's a good thing. I don't think it's a good thing. Yeah. The insiders are telling you something.
Yeah. But there's another thing is that we noticed that, lately, this entire thing about economic projection, because of interest rate high, we already see some slowdown in the economy, right? I think this one for sure, it will hit digital advertising. It hit all forms of advertising, actually. And that's why I saw that, you see, when Meta drop a lot, let's say if Google is still able to maintain, right, then we might say, okay, this might be something specific to Meta. But then now, especially in the past 1 week, we saw that both Meta, Google, they all dropped together, right, including Amazon as well. So I think this one is more like market is slowly digesting that we are expecting to see more growth. We're expecting to see recession in the future. And when this hit, right, you can see that their revenue will definitely hit. And people just sell before all this become a realities, right? So I think this is why, I mean, if it is just because of the economy, I'm much more keen to say that actually might be good to own the business, but not specifically for Meta, because for me, I currently don't have Meta at all. I sold it quite some months ago. But let's say if I want to get some positions on digital advertising, right, I will go for Alphabet or Google. I think YouTube is somewhat still stronger as compared to Meta. That's my view. But I think both of them also dropped to kind of very low valuations.
Yeah, so what you're essentially saying that it's not a management problem, but it's an economic problem.
Right? Depends on the period, because if you say from beginning of the year until, let's say, June this year, right, or some May this year, I think that one is really because Meta, they have some specific problem, right, which is the privacy things, and then they are not able to track the data and so on, all the iOS things, right? I think that one really hit them a lot. But for the recent 1 week one, I think this drop is across all, and this one is really because of the economy. So Meta is kind of like they get hit for both macro and also some company-specific challenges. And also, of course, TikTok side also is still a huge competitors, right? So I think this is also something to pay attention to.
I won't consider TikTok a problem because you never really know how TikTok financial statements look like.
You mean they are burning a lot of money and this is
not sustainable? You never know. Because back then when Grab wasn't even public, you would think that ComfortDelGro is finished, right?
Yep.
But Grab financials looks terrible. So they deserve a very bad price, Not saying that ComfortDelGro is a good company, but I'm just saying that when the financial figures are not public, we shouldn't think of it as a strong adversary. You know what I mean? Because some things just can't last forever. This cash burning can't last forever.
Yeah, that's true. Yeah, if we have some visibility in terms of how much cash burning that they're burning, and then are they strong enough to continue to do this, and how fast can they turn profitable? If they really, I mean, for TikTok, right, if they really able to turn profitable even with this kind of spending, right, and then it become really, really scary. But I agree with you, I won't be surprised if they really burn really big monies and not profitable at the moment. And when the interest rate go up, right, then their shareholder also need to think twice whether to continue this kind of cash burning, right? And that one, if they crashing down on that, it'll be interesting for companies like Facebook. Then they can at least doesn't need to face stiff competitions, right? Yeah, I think this one for those who invest in, let's say, Meta or Google or usually these two companies, or maybe like Snapchat, right? So you might want to pay attention to. I think the competition is still something that you need to watch out for. Okay, let's come back to the question. I think we kind of like touched a couple of important points of Meta already. But just come back to my own view is that I do own Meta stocks now, and I would rather go for Google if I want to get some exposure in digital advertising. So this one is really depends on how much confident you are in terms of their management execution and how much you believe Metaverse is going to work out. I think these are all still question mark that you need to figure out. Okay, I think this one, is Bitcoin truly decentralized? Just a few mining pools control more than 51% of the hashing power. I have no comment on this. I think, I think Bitcoin, even if you want to claim they are not 100% decentralized, I think they are still the most decentralized compared to the rest, right? So it's not, this is not like 0 and 1. This is not a binary thing, whether yes or no, right? When it comes to decentralization, I think it's more about like how much is the scale between like 100% centralized and nothing is 100% decentralized, right? So and you really need to compare against what are the alternatives that you want. For example, like US, right? US dollar is also centralized. Basically, US government decide how to manage how Federal Reserve work. For example, you don't agree that Federal Reserve need to hike rate, but you have no choice because they are doing that because all this power is centralized to Federal Reserve, right? So this is something about the centralizations now. So every companies will have centralized power in terms of how they conduct their monetary policy, and then bank will have their centralized power in terms of how to safeguard your data and so on. So this is basically centralizations. Usually centralization is not a problem if you are, the power is centralized to yourself. It becomes a problem when it is centralized at someone else and you have no control at all, right? So that's why there are people who kind of fed up and just want to get up from all this like this kind of platform. So US dollar is also one platform.
For mining pools, you can think about it as, imagine you have a computer right now and you go and join a network, which is a mining pool. But anytime you feel that the mining pool is not serving your interest, you can just leave the mining pool and bring your mining power to somewhere else. That's essentially what the miners do all the time, which is why you can see a lot of examples of, like, right now there's quite a number of mining pools and services that are going bankrupt because they borrowed money to do things, and then now they are going bankrupt. You can see that those miners that are using their pool just decide to just leave the network, then make them even more insolvent because they are unable to pay with even reduced hash rate. So from that sense, you can kind of see that it is decentralized because the mining pool cannot stop any miners from leaving or joining at any time. They probably can stop people from joining, but they cannot stop anyone from leaving, or people can just turn off their machines.
Yeah, exactly. I think things about all this, especially take Bitcoin as an example, right? So you own Bitcoin, you have your wallet, then you make the call on how to make the transaction. You are your bank yourself, right? So that's if you own the Bitcoin. And if you are miners, then you also make your own decisions on like which mining pool you want to join and so on. So the power is really on whoever own whatever that you are owning. If you are owning coins, you can transact to whoever you want. And then if you are owning the mining capacity, then you can also decide which pool to join or turn off or whatever, right? So this is the principle behind the decentralized, right? Whoever own the capacity, they can just decide for themselves. And if you want to change the algorithm, you basically need to get the consensus, need to get the majority in order for anything to get changed, right? For example, if everyone just agree that 21 million doesn't make sense, we should do 42 millions. If everyone agree, or let's say if majority agree, then you can also pull that off. But you need the stakeholders' agreement in order to pull out any changes, right? So I think that's the things, right? But for other platforms, US dollar platform or other platforms, right, you are basically just listening to whoever own the platforms. For example, if you develop apps on iOS, basically you just have to listen to Apple's, right? So this is like centralized power on Apple's side. So if you understand this, you know where this decentralized coming from. Decentralized is not like some buzzword, right? There are some true meaning behind it, right? Then it's really depend on you, like whether you want to like participate in all this stuff. But I think this word is itself quite like you need to embrace it. Okay, I think that's on the question. Anything that you guys want to discuss or to talk about, we can discuss before we end the call. Okay, if not, I know that this week, right, market has dropped quite a fair bit, right? I think during around June, it makes, let's say, like a local minimum and then just bounce up, and then now it's coming down and testing the previous support, right? So, but if you look at the market, I would say that it's quite bad. If you look at the, this drawdown, right? S&P 500 drawdown is about like 24% now. So the last time it was this bad was, let's say, during COVID, it was at 35%. But you just look at this drawdown chart, you can see how serious it is. But this is still nothing compared to global financial crisis 2008 and 2009, and nothing compared to dot-com bubbles. But still quite painful, as you see. This one doesn't happen like every month, right? This kind of drawdown. So, and then if you look at Nasdaq 100, I think Nasdaq 100 is even, the drawdown is even higher than COVID crisis. Now we are around close to 35% drawdown. So I know that for those who, let's say, start investing after, let's say if you invest in QQQ and then you just started, like in the past few years, I think this kind of drawdown is already something that kind of scary to you, and then you might be thinking, oh, there's so much concern, and then thinking that, okay, why should I invest, right? Because now Fed is going to crash the market, economy is going to hell. Like it seems like it just makes sense to pull out your money and then just stay away until things calm down, right? I think this is totally normal to have that kind of frustration, especially the kind of drop is not like COVID where you just drop for like, let's say 2 months and then we just have a quick recovery and things are well, right? This one is like a slow burn, and then slow burn is kind of like quite tough to handle. This is not like a 100-meter sprint and then after the sprint you can just relax and okay, this is like a marathon, right? You just run and run. It seems that it's never finish. Not so easy to endure. But I just want to say, like this group, right, we are mainly talking about like long-term investing. We're talking about like long-term is not like 3 years, 5 years, right? This is really for your retirement. I believe like some of you are still, even if you are 40 years old, 50 years old, you still have probably the 3, 4, 5 decades ahead, right? So if you look ahead for 10 years, 20 years, this kind of like whatever things that you are worried about, right? It could be like Fed highs, it could be like economy, it could be anything of this. These things, it could last 1, 2, 3 years. It won't last 5 years, 10 years one, because whatever business cycle that you're looking at, usually they don't go beyond 10 years, meaning that if you just say 10, 20 years, probably will go through 2 or 3 cycles. So it doesn't matter which point or which period within the cycle that we are currently at now. So that's what I would say. If you think that all this is too hard, and then maybe it's good to tune out a little bit, take a break, but the portfolio just need to stay invested, and then just need to just take it as this is fine, this is okay, even though the market keep on going down and down. I think this is fine. As long as continue to DCA, especially when you feel there's fear in the markets, right? And you just continue to DCA. After 3-5 years, you will be very happy with your decisions to just continue to DCA. Just because, there are people, especially traders, they just get out from the market, right? Or even some of them will short the market, just write the trend down, right? So let them play their games. People play short-term games, let them play. Hope that they will earn money writing these things down, right? I think that's fine. I'm not saying that we should we are on the long-term camp and then say something bad about the short-term, right? It's just different type of games, right? So for those who are doing short-term, they want to short the market, I think that's their things, right? But for us, especially even if you have a mix of long-term and short-term portfolio, at least for your long-term portfolio, you just need to stay invested and then just endure this kind of slow burn, let it play out. Just believing that as the market feel there's all this fear going on, there are people who think that as the market feel there's all this fear going on, there are people who shorting the market. It just bring the stock level down, right? The risk premium actually increase. And when the things calm down and when the economy is going back again, become improving, then that's where your returns is made, right? But during this period, you just need to accumulate. You just need to stick to your plan, which is just accumulate things. I'm not saying you should all in now because now it's bottom. For those who listening to my talk in the past 1 or 2 years, right? Regardless of where the stock market level is, I won't say, wow, now it's the bottom. I think that is not a wise kind of thinking, because if you think now it's bottom and then market just try to humble you and then just trash another 10 or 20%, that will even frustrate you even more, I would say that regardless of where the level is, just be mindful that yes, it could drop. It could drop another 10%, 20%. Let it drop, right? It's even better, especially if you're buying. And then just buy, just stick to your plan, buy consistent amount, just DCA along the way. And then after this thing pass, right? Say, for example, if you just invest in S&P 500, there will be period where you see we have 35% drop, or let's say even crash level that is 50% drop. Once you go through this and then you become veterans already, you know how crash looks like. Then in the future, when we have market a bit shaky and then draw down another 10, 20%, you will just say, I have went through this, right? This is nothing at all. Okay, so I think when we talk about long term, this is the type of the volatility that we just need to learn to tolerate and just build your emotional strength to withstand this kind of volatility. When people say you just invest in equity, you get 10%, sounds very, very easy, very nice. Yes, you look at history. Yes, you just buy S&P 500 since, let's say, 50 years ago, you just get 10%. Sounds easy, right? But when it comes to all this, past drawdown where you have, this is the crisis when the inflation become 20%, this is the period, right? And then the 86, what they call it, the Black Friday or Black Monday, I also forgot the name, .com crash and 911, all this period will just pass now. So we just need to stay invested and then just stick to our game stuff, which is just focus on the long term and believe that the economy will be fine now. So I think, it's just some of my thoughts when looking at market situations. And of course, when I say fear in the market, there's also some measures, right? This is a fear and greed index. We are officially at 24 at extreme level, but knowing that when it comes to extreme doesn't mean it will go up, right? Sometimes this middle, it will just going down and down and down to zero, and the market will just continue to melt down. I think this is also possible, but as long as you continue to DCA and buy at this kind of level that is excessively cheap level, right? I'm not saying now we are excessively cheap. If you want to know about valuation, maybe you just go through, I think just 2 weeks back when I go through a couple of 6 matrices that talk about market valuation. Even market has dropped 25%. It is still not cheap. We can say that it is a fair value, not not overvalued anymore. It's fair, but definitely not cheap. But at least if you are DCA now, you can be be assured that you are DCA at a point of time where there's some fear in the markets. People fear about economy, they fear about Fed high. There's always something to fear about, right? And now we can really feel this. And this is always a good time to accumulate. Okay, I think it's just some ranting on my side. Any questions or anything that you guys want to share?
Yeah, I mean, if you are doing dollar cost averaging, right, you are relying on a mechanism that is proven over probably close to a century of statistics that this is the easiest approach to investing. You just have to trust that things will go well, you know. As for those of us who are doing active investing, picking stocks and all that, this is really quite a terrible time. I think everybody or most of us are in pain. So we just have to gracefully accept a few things. First, there will be bad times, there will be good times. Some of us do very well during the last 5 years, and maybe this is the time where you have to suffer. Almost every so-called legendary investor who probably average 20% annualized, they will have 1 or 2 years in their career that they had to suffer like this. There's a lot of self-doubt, a lot of worries. The second thing that I like to say is that the market has this uncanny ability to know when things will turn the corner. So you have to respect the market, even though that you should not act with the market as your counsel. You should just, if you are dollar cost averaging, there's simply really nothing much to worry about. But if you are actively investing, you have to just hold on and try not to time the market in that you can sell something and then buy back cheaper. I think that is really a very difficult approach, because when, let's say, if you were to sell something now and it goes down maybe 20% more, you start to feel pretty cool, pretty glad that you have sold off. But when the market turns the corner and approach and goes up, you start to have all kinds of doubt, and you might even start to think that the market is wrong. There's so many problems. Why is the market doing this? But really, during my short 6 years of looking at the market really has this ability to predict ahead of times when things will just turn the corner. So just hang on if you could.
Yeah, thanks a lot, Boonsong. Yeah, need to respect the market. That's very true.
Benjamin Graham, his line, he says that the market is here to serve you and not to guide you. And that's one other line stolen from the value investing camp.
Yeah, that's very true. Because if we look at the market, let's say S&P 500, I don't say it is fair, but I mean, at least for the companies that I'm investing in, right, I think some of them is just like slowly, it's already getting at a very, very, very attractive level. And this kind of price level, price doesn't go cheap for no reasons, right? I think, let's say if you invest in the wrong companies, right, it becomes cheap when there's so sign of either the business have really problem or the execution got problem. There's always all these like individual companies problem. For example, the Facebook or Meta that we talk about, right? They are facing the executions, and then they're facing competitions problem, privacy problem. These are the specific company problem that you need to be okay with if you invest in individual companies. But sometimes there are also periods where the company itself is fine, but yet you are getting a good kind of like attractive price level. And why is it so, right? So I think these are the period where, the macro economy, the macro environment is just like so how to say, very bearish, and then very there's extreme fear in the market, and all companies just penalize because there are people who really short the market, and then they just go using all these S&P 500 futures, and then they just short the market, and this one will affect the index directly, right? So all companies get penalized, and that's where you can buy some really, really good companies that usually trading at a premium. And now at least I would say it's dirt cheap. For some of them, let's say like Google, it's not like dirt cheap, right? Even Meta, I won't call it dirt cheap if you consider the problem that they're facing. But at least they are now already trading at the level that you don't need to pay a lot of premium just to own these companies. And as long as their moat, you believe their moat is very strong, right? Actually, the future returns will be quite good now. So I think definitely, invest in something that you understand. And then if you don't understand, I think even just go for the index, S&P 500 or QQQ, or even some index that you already follow, you understand the exposure, the companies in there. I think it's also like good to accumulate, right? Yeah. So, and be comfortable to buy now, looking at it drop and still steady about it. I think this is talking about the emotional management as well. Yeah. Okay. Anything else? If not, we just close the call, close the noon time already. All right, then thanks a lot for joining. I think we have more people joining after we started. Maybe people just skip the beginning period section where I just go through all this boring stuff. But let me know all this. If you think this is not helpful, you let me know, and you want to change the structure, also works for me. For those who are watching this, and if you want to ask questions, you have to join the Telegram group, and usually I will send the Slido, and then maybe you can just submit your questions. And if you are watching this video, you have questions, you just post your question in the comment section. We might also pick it up over the coming weeks now. So thanks a lot for joining, and then let's meet again next week. All right, thanks a lot. Thanks, Boonsong. Bye-bye. And YCX, bye-bye.
Bye.